You know, I have a theory about why real estate prices in Vancouver are so high. It's my considered belief that it's because we have the best grow-ops in Canada, and you know, it's very good cash flow generating real estate, which we support a great deal. I do want to share something with you. This is something you may have seen, but it was a very interesting video on whether you need to be lucky to get good investment results.
So this is my friend Frank and his retirement plan.
One golden crown.
Come on, Frank. How long have we known each other? Go to E-Trade. They got killer tools, man. They'll help you nail a retirement plan that's fierce.
2 golden crowns.
Do you realize the odds of winning are the same as being mauled by a polar bear and a regular bear in the same day?
Frank!
Oh, wow. You didn't win? I want to show you something. It's my shocked face.
So perhaps relying on luck may not be the best thing after all. I'd like to start by taking a look at some things related to the macro picture, global house prices. Every quarter in The Economist, they do a publication of how prices for housing, specifically in housing, is looking around the world. I'm just going to focus on 3 areas that have relatively depressed housing prices right now. And they include the US, Japan, and Germany. All of those 3 countries are deemed to be undervalued from a housing perspective. At the same time, Canada specifically is noticeable at being 23% overvalued. How do they determine what value is? They take a look at what the normal historical price to rents has been in each of these countries, and then they compare them to today's prices. So the value proposition from a Canadian perspective, and we're going to look at our local market in just a bit, it's an interesting change and switch that's occurred over the last, this was not the case a year ago. These numbers were quite a bit different then. There's another little toy. This is a website that The Economist had. If you really are interested and quite anal about what happened to the history of housing prices, you can try this yourself. You can go there to a particular website and you can plug in a quarter, 1987. And we took a look at the housing prices for Australia, the UK, the US, and Canada. And interestingly, over the last 23 years, the lowest increase in housing prices overall, not necessarily in the last few years, has actually been Canada. So this sort of argues against the fact that our real estate would be overpriced, at least compared to our cousins. But if you went to the same website and you compared it to other countries where the culture of home ownership is a bit different, for example, this is in the last 10 years, we're looking here at Japan, Singapore, and Switzerland, and Germany would also fit into this category. In each case, all of their housing prices, these are very rich countries, they're very crowded countries, they have very little inflation, and in each case, their housing prices have risen far less than in Canada, and in most cases, they basically haven't risen at all. In fact, in Japan, they're about 40% cheaper than they were 10 years ago. So one of the arguments we tend to use in Vancouver in particular is, number 1, we're surrounded by mountains and a border. Number 2, there's no more place to put people, et cetera, et cetera, et cetera. You have to appreciate that Japan has got 130 million people living in an area 1/3 the size of BC, and it's full of mountains. And if you take a look at a lot of countries around the world which have a very small amount of space, it doesn't guarantee that housing prices are going to rise. So housing prices can rise for a number of reasons, but this is not likely one of them. On the other hand, these countries all have much higher increases in house prices than Canada. This includes Australia, Spain, Ireland, France, and South Africa. And at least 3 of these countries obviously are in serious economic trouble right now, and almost all of them have had a major decline in house prices because of how far the prices rose in the first place. So it's very hard to use anything from an economic perspective to predict what's going to happen to housing prices. We'll come back to the Vancouver situation in a bit. Now, this is a very interesting cartoon about the perfect storm in the US between subprime mortgages and foreclosures, essentially crippling the housing market in the US. And obviously, for years, very incredibly lax lending occurred, and now companies and banks are having to deal with the foreclosure issue, but it's kind of a paradox. If they keep foreclosing on properties, they'll push more properties onto the market, which will drop the price even more, which will mean more properties have to be foreclosed on. It's like it's a vicious circle. So, another thing that I always worry about a little bit is something called covers. I don't mean the kind of covers, you know, when you're buying a CD by James Taylor doing everybody else's great albums. I'm talking about the covers of magazines like, this case, Time. This cover came from 2005, right at the peak of the U.S. housing market. It says basically, why we're all going gaga over real estate, will your house make you rich, et cetera, et cetera, et cetera. Time magazine has a stellar reputation in managing to pull exactly the wrong time to make a pronouncement about something that's going to be a good investment. So recently, the reason I'm mentioning this is recently this summer, my partner Rob Adel sent me this other slide, which said, this came from Time magazine about 2 months ago. In other words, is it time to reconsider housing? Should you be basically rethinking home ownership? I'm not sure this is a contrarian signal in the U.S., but it does make me pause to think about the fact that maybe at some point in time the decline in the U.S. markets will be over. I'd like to think that's the case. Unfortunately, the data doesn't actually support it. So let's take a look at the housing problems. What you're looking at here is not actually a weather picture. It's a chart of the percentage of homes that have negative equity in the U.S. And you notice that they're kind of spread out on both sides of the country. So one of the problems with housing is not a national market. We talk about the U.S. housing market, but it's not a U.S. marketplace. It is a regional marketplace, much the same as Europe. And if we take a look at the area that's also under mortgage stress, essentially it's the same area. So if you're in, if you're Ma and Pa Kettle and you're in South Dakota somewhere and you've been sleeping for 10 years, you have no idea anything problematic with housing has ever occurred. Because your house is exactly the same price it was 10 years ago. It's the same price it was 5 years ago. It never went up, it never went down, it's the same price. That's not true, obviously, for a lot of extended areas around the country. So very much a regional issue. And as a result of that, this Case-Shiller index, which is an index of housing prices in the 10 and 20 biggest cities in the U.S., is off 30%. But recently, and this is important, recently for the first time in years, it actually had a small increase year over year. Now, I don't know that this is a turn because there are some still pretty big dark clouds in that U.S. housing market. So this graph you're looking at here shows two things. It shows the inventory of homes that are listed for sale, and then it shows something called the shadow inventory. So these are houses that are either in serious delinquency, in foreclosure, or already been taken over by a bank but not put on the market because banks know that they can't really sell them for any serious amount of money. So they'd rather not necessarily recognize the losses that are embedded in them. And that inventory is 5 million homes, and when you add it to the existing inventory, it's a 22-month supply of housing for sale, and normally that inventory would be 5 or 6 months. This would take many years to normally unwind, and this is in addition to the fact that 25% of all homes in the U.S. that have a mortgage have no equity in the home. The mortgage is worth more than the home is. And that's before you factor in this. So realistically, house prices in the U.S. probably, and John's going to talk about this more, but they probably have some distance still to fall in some markets, but not in all markets. A few months ago, there was a magazine article, really well written from Barron's magazine, about the shift to what they called the renter nation. By that they meant they referred to this particular graph here. What you're looking at, this is a graph of the percentage of people in the U.S., households that own their own home. Again, obviously anybody, once, if the 60% here owned their own home back in '65, 40% rented. Well, that percentage went up and down, and if you went back, they've got the percentage going right back to the 30s. And then it peaked here at the peak of the housing market at 69%. That was because the government had specific policies to try to encourage home ownership. And what they did was they said, we're going to look for cheaper mortgages, easier underwriting on mortgages, and basically the market took off. So being a homeowner made a lot of sense. Well, that marketplace has shrunk, and these people here that are shrinking, this percentage that's shrinking, are essentially all renting. And John's going to talk about the specific impact, the demographic impact, and this impact as a positive from an investment perspective. So one real estate area is part of loss, it's another part of gain in the case of rental housing. In Canada, we have a different situation. We sort of have managed to skate through this whole crisis pretty smoothly, and in some cases for good reason. First, our housing market just simply didn't decline anywhere near as much as it did in the US because it never rose as much in the first place. We already have more people employed than we did when the recession started. The US has 5% fewer people working. I saw some statistic the other day that said that the number of people over 65 that are starting to work, increasing their work lives, has gone up by something like 800,000 or 900,000 in the US. And that represents 100% of all new jobs created in the last 18 months. In other words, over 65s have taken all the jobs, and there are no jobs for people under 65. So that's the net result. And Canada has less debts than a lot of other countries. Not less household debt. We have a significant amount of household debt, but overall debt, the overall debt burden in our country is far less than a lot of other developed countries. So what does that mean for housing prices? Well, if you take a look at this Case-Shiller index and compare it to both Canadian and Vancouver prices, you go back to 2005, US prices in the blue were much higher. By today, US prices are lower, and in fact, what's actually occurred in a span of less than 5 years, we've gone from being 40% cheaper than US housing prices to being 20% more expensive. That's a pretty big shift. The one good news from a Canadian perspective, this graph is really busy, is it really says one major thing. We have 44% of, Americans have 44% home equity against 68% in Canada. So we have a far lower debt as a percentage of house value in Canada than they would in the US, which means we have a bigger buffer. So we take a more conservative approach when it comes to housing in Canada. We also have a default rate that's only 1/5 that of the US. So the signals in Canada are mixed. Our prices have definitely gone up. In a lot of other countries, the prices have simply stayed flat or dropped. But at the same time, we have not had the explosive increases in prices over the last 10 years a lot of other countries have experienced. This is Vancouver, the greater Vancouver area. This is from MLS. And what you notice here is that in the last 10 years, housing prices have risen about almost 10% a year. And in my mind, that's not a sustainable growth rate. It's far faster than the growth of incomes for the people who are buying homes in the greater Vancouver area. When the crisis hit, prices dropped 10 or 15%, and they've already bounced back, recovered almost all of that. But there's just this little hiccup, if I can point this thing here, at the end, a little dip. I don't know where that's heading, but I wouldn't be surprised to see that continue in some way over an extended period of time. And there's some reasons for this. Because this graph shows housing prices in Vancouver back to '77. And if you go back that far, first off, the long-term growth rate is about 8% a year. There were two periods in the '80s and '90s when prices dropped. So a lot of people who live in Vancouver, especially who've only lived or bought homes in Vancouver in the last 15 years or so, don't believe house prices are capable of dropping in Vancouver. You know, that doesn't happen. You know, but in actual fact, if you've lived here long enough, you know that that's quite possible. Prices drop. And when they drop, they typically take 6 years to recover from their prior peak. It's not something that occurs quickly. In this last correction we just had, the prices dropped, but they recovered to a bigger number than their previous peak in less than 2 years, and that's unusual. So if we take a look at that long-term growth rate and stick it over the last 10 years, our housing prices would be 15% less than they are today. So it's not a prediction on my part that that's going to happen. It's just an observation that most times prices revert to the mean. So you should expect, I think if we were lucky, we would expect maybe prices to be flat for the next 3 or 4 years. And if we're not lucky, interest rates or mortgage rates rise, those prices could correct pretty quickly. Speaking of mortgage rates dropping, one of the reasons that prices have been sustained in a lot of countries, and certainly in Canada, is our bond rates have dropped 3.5% in the last decade, but the inflation rate basically has stayed the same. So we can't expect any positive push from lower mortgage rates, but we can certainly expect some negative outcome from rising rates. Because most people, when they decide to buy a house, the issue isn't the price of the house or the apartment, it's the monthly payments. And those mortgage rates go up, those monthly payments will change. Let me switch gears quickly to the U.S. commercial real estate market. This marketplace has gone up and down much like the housing market in the U.S. in the last 10 years. These are U.S. prices. And it's more or less about 10% ahead of where it was in 2000. But for a Canadian investor, because back then the dollar was at 67 cents and now it's at 97 cents, when we are looking at assets in the U.S. on the commercial side, they're 28% cheaper today than they were 10 years ago. And that's one of the compelling issues, one of the things that Wayman will talk about with respect to Spire. In terms of, is real estate better than the stock market? Well, the data suggests not particularly. This is the total return of the American stock market against the American REIT index for the last 40 years. There's not much to choose between the two. So stocks are not necessarily worse investments than real estate. It's typical that people behave better with the real estate. The other advantage that real estate has is it has twice the income. More of the return from real estate comes from cash flow. So in Canada, real estate in the last 10 years has actually been quite a bit better than stocks, about 4% a year better. But one of the things about real estate, and this is one of the things we really like about it, is most of the people that we know that are experienced real estate investors, they focus on the cash flow of the investment. They actually don't focus on the price of their real estate. So they don't know, typically on a day-to-day basis. They're not looking in the newspaper or on Google to see how much their house or their investment in real estate is worth. But they always know how much rental income is coming in. When we make investments in equities that are publicly traded, we behave differently. We know what the price is every day. We get nervous if the price changes. We often have no idea what the actual income, dividend, yield on that investment is. And our focal point needs to be on cash flow as opposed to price. To give you some proof of this, real estate trusts in Canada, I think I mentioned, earned 11% a year. This is the average for the last 10 years. But take a look at how volatile that price is over the last 10 years. Because real estate trusts are stocks as much as they are real estate, because you can buy and sell them every day. And that means investors behave erratically whenever they can do that. So look at the 2 years from 2008 to 2009. The price of REITs changed by 93% in 24 months. Now, it's a safe bet that the price of real estate didn't change 93%. So that change is caused by how we behave in the stock market. It has nothing to do with what the underlying asset is inside that REIT. That's the real estate market is closer to that 11%, give or take a few percentage points each year. So just a quick little story about our first real estate project we ever bought. It was a kind of a scuzzy shopping center, to be fair. Some of you, I'm sorry, I know some of you probably invested in it. I didn't mean it in a derogatory way, but. We bought it in 2000, and it was a retail center, B center, 8.3 million, 2.3 million cash down. And back then we had a mortgage rate of 8% and a cap rate of 10%. We needed that 2% spread to make the return. So since that time, Spire has changed dramatically. It's now still getting that 2% spread. It has a number of U.S. assets, a portfolio of about $200 million, of which $95 million is mortgage debt. And since 2000, we've been able to generate a rate of return of 15% a year net of fees from January 2000 all the way through to September of 2010. Now, I'll tell you realistically, we were very fortunate in getting that return. Realistically, our objective going forward is to try to get somewhere between a 9 and 12% long-term rate of return from the real estate that we're acquiring today. So to sum it up, basically our position is this, that we still see a struggling U.S. housing market. Renters are coming back, which is going to be good, and John's going to discuss this in much greater detail in a minute or so. I think Canadian housing is due for some kind of correction, but probably not a crash. Because our dollar is very strong and because the situation in the U.S. is so weak, we think the opportunities, the interesting opportunities going forward, a lot of them will come from the U.S. We still have good spreads for Canadian assets thanks to low mortgage rates, and we're doing our best to try to find the kind of investments that make sense. And for registered accounts, because we can't put the hard real estate into registered accounts, the REITs still make sense. They generate good cash flow, and they're still about 30% cheaper than they were about 3 years ago. So with that, I'm going to turn this over to John, and John's going to talk about the U.S. multifamily marketplace.